Hi, everyone, and welcome to the 95th episode of the Veritas fact-finding series. And today, I'm joined by my good friend, Albert Collu.
Hi, Albert. Thanks for having me. Hi.
And this is very exciting because this is the first time that we've actually done a live in-person interview in our studio, one-on-one. And also exciting, this is your third fact-finding session with us. You were actually the first guest, the second guest.
Wow.
Second guest on our fact-finding series, which we started back in 2020. And it was on April 15th that you did your session on April 15, 2020. We were talking about where the housing market was going and what a ride we've had. Now, surfacing facts and revealing truths is a never-ending quest for us at Veritas. In each episode of the Veritas fact-finding series, we go on the ground and speak to industry professionals in an unscripted, candid video format to discover how an unscripted, candid video format to discover how we can make better investment decisions. In this series, and with everything we do, we believe the facts empower investors and that better information leads to better investment decisions. By way of background, my name is Anthony Scilipoti. I'm the president and CEO of Veritas, which is an independent equity research firm based in Toronto, Canada. And I'm proud to say celebrating over 20 years, 100% employee owned and operated. I have a quick note disclaimer. This broadcast is not to be taken as investment advice, and participants and or employees of Veritas may own securities discussed in this broadcast. While we love all our guests, and particularly Albert, of course, this session may contain forward-looking statements, investment opinions, and comments that we may or may not agree with at all.
Well said.
Quick comment on Albert. Now, I've known Albert, what is it now? 30 plus years.
Yeah.
We played hockey together. We coached hockey together. Now that we're not coaching anymore for a while, we have to get back to that. That's a separate point which I don't want to talk to you about. But now our biggest pastime is talking about housing. And I bring Albert so often on these shows because he has a pulse on what's going on in the mortgage industry. And if you can't get financing, you can't buy the property. And his history going back to 2009, he started his own mortgage brokerage called Argentum, which he then sold to Mortgage Architects. He then took on the president at RECO, which is Canada's largest independent network of mortgage brokers. That was sold to M3. After serving at M3 for a while as its president of operations, he's now the president and CEO of Marathon Mortgages, which is a monoline lender here in Canada. Albert, why don't you just tell us a little bit about what you're seeing in the lending space right now?
Geez, you know what?
I left it wide open.
Yeah, it's wide open. It's such a hard place to start. Maybe it's fitting because you talked about me coming on in April of 2020.
Yeah.
And I think it's important to refresh everyone's mind that back in April 2020, if we can all recall, the prognosis was pretty dire. Everybody was jumping off cliffs. The housing market's going to go down 20-30%, and businesses are going to fail, and all these types of things. So what we learned back in April 2020 is we know nothing, because we absolutely saw just incredibly unforeseen pent-up demand and a complete change in dynamics, not just in the workplace. We saw people leaving the urban centers to go buy rurals. Yeah. All of a sudden, there was a thought that, hey, I'm going to work from home all the time. Let me go buy a cottage. Let me go buy some sort of recreational home. Anyway, it's all to say that the market went nuts. And what may have been arguably a fuel for that is the interest rates were just impeccably low. By the end of 2020, the mortgage rates were, you're talking less than 2 on a fixed rate.
For 5 years.
For 5 years, correct.
We're talking 18 months ago. Like, this is the thing to think about.
Months. Well, let's actually be a little bit more current.
Yep.
About 2.5 months ago, the rates were about half, depending on the type of mortgage, but half to a third of what they are right now. All this within an 8 to 12 week period, right? Which I think.
What are the numbers specifically we're talking about?
So today, if you want what we call insured or insurable, I would say as a proxy, about 5%.
Insured or insurable means that's you're unable to pay the 20% down and buying as a first-time home buyer?
No, not necessarily. That high ratio suggests you have less than 20% down payment or equity, if you will. Insurable means still fits in within the confines from a securitization standpoint.
Okay.
But it's very, very possible to have more equity than that in an insurable. Uninsurable means that you've got a home that's above $1 million, as an example, in value,
Right.
not the mortgage. This is going to be an important point, actually. Uninsurable means I've got a home that's $1 million plus, or, you know, the second other driver is it's a refinance, right? And the third piece is if it's an amortization over a certain stretch of time. So to the question at heart, it's been an incredibly odd 2 years in terms of how the market has been responding to COVID. And now we're just going at the pace of lightning and trying to correct what's been already done. And it's having, in my opinion, some really unintended consequences, which I'm sure you'll probe a little bit.
So when we spoke last year, I went over my notes and did a summary. You thought at the time, look, we're headed higher. You thought in April, this is April of 2021, you said, look, we're going to be talking a year from now and we'll be higher in prices. And that's happened. You also thought that there was a good chance that rates were going to rise. You didn't know by how much, but you said the rates can't stay this low forever. And you weren't sure what was going to happen to the market as a result. So here we are. And so far, the market is starting to show some signs of weakness. We just pulled up some stats outside of GTA. You're really starting to see some movement on the negative side. The further away from the core you get, the more negative.
Okay.
But in the core, still holding up decently. What's it like getting a mortgage today? Just compare it to a couple of years ago.
I'm going to use the word miserable, particularly with an important segment, first-time home buyers, right? It's nothing's really changed in terms of what we call underwriting policy. We're still underwriting in the same way for the most part that we used to. But when I say miserable, you know, there's a lot of discussion, I would say the general populace by now knows that there's a stress test involved. But what's not being really discussed right now, the stress test has pretty much erased itself.
Let's talk about this.
Because the stress test, for those that, just as a refresher, says that you need to qualify at 5.25. More specifically, actually, the stress test says 2% above the mortgage rate or 5.25%, the greater of these two. Well, I just told you that the insured rates are about 5%, and there might be a slight difference here and there. So, you know, we've got people trying to get into the market, okay, that are trying to qualify at 6.5–7%. There's a small subtlety in these rules that says if you're trying to gain a mortgage, but you want an adjustable rate mortgage as an example, that
is variable rate. That's different.
Adjustable rate and variable rate are different products. Actually, people think they're the same. They're not.
Please explain.
Okay, so a variable product means you have a fixed payment regardless. So just give you an example. Let's call it $1,000 a week, and as that prime moves,
yep,
you're still paying $1,000, but your proportion that gets paid to interest or principal obviously changes.
Yep.
Whereas an adjustable says, oh, okay, prime's gone up, so your payment's moving up next month, as an example. Right, so your $1,000 might be $1,200.
So your amortization period stays the same.
Correct.
Whereas in the variable one, your amortization period fluctuates.
I mean, it's underwritten with a fixed amortization. I think the more salient point is that as those rates, specifically the prime rate increases, quite simply, you're paying off less principal.
Right.
Right. In total sum. So that's kind of what you were asking about with the pain, right?
Yeah. So let's talk a bit back to the stress test, because that's where you were going.
Yeah. So, someone who is trying to get a home today, I mean, first of all, I think we can all agree on this, right? Is that even before these last 9, 10, 12 weeks, it's getting pretty tough for these new homeowners wanting to find a home because of supply issues, right? To qualify at 5.25 and, on and on and on. And we just exasperated that. So, I would say that the government officials that are putting in these policies, first of all, I wouldn't want to do their job because I don't think I can do any better. I got to be honest with you. But the reality is we understand inflation is getting out of control. I don't think anybody can argue that. And I think something has to happen. But the unintended consequences, what we're trying to do there is really having adverse impacts on the households and consumers. Now, we're talking about qualifying. We're talking about new buyers. But I think there's another important conversation.
Sure.
And that important conversation is, let's not forget 3, 4, 5 years ago, people were getting mortgages.
Yep.
And those rates were nowhere near what they are today. We have a real, not anecdotal, we have a factual challenge where people may get sticker shock on renewing their mortgage. Their balances may have been paid down because they've paid away for the last 3, 4, 5 years. But we have, and I can tell you, not anecdotal in any way, shape, or form, we have seen situations where people are renewing with rates close to 3% higher than, or triple, excuse me, than where they were.
Triple what they were 5 years ago.
Correct.
And so are they now?
Sorry, and to put that in context, just remember, about 5 years ago, it was not uncommon to find a mortgage at 2% or less.
Correct. So now are they, as a result, deciding to sell the home? Are they can't
No.
make the payment? What are you doing to help them out?
No, I mean, I would say this, I think it's a little bit too early to make any forecast on arrears, defaults, all those yucky things, because the one thing that we always know is the last thing that someone's going to let go of is their mortgage payments, right? They may miss a car payment, they may miss a hydro bill, they may sell the skidoo that they bought, or the boat because they thought they were working from Bob Cajun the rest of their life. Those things are the first indicators in my experience anyway. So right now there's no alarm in those areas, arrears, defaults. They're actually right now as we speak, they're still historically low.
Yeah.
But I think it's too early to tell what these impacts will be in the longer run.
So what's making you nervous?
The rate of change. And I really don't know how the government actually handles it. It's easy for me to sit here and say they should have maybe smoothed it out. I think that the opportunity might have been, we talked about April 2020. Well,
should have started raising.
It should have started then, because, you said your view was that we were going to crash and burn right off the cliff. But when you saw quite the opposite, in fact, we were starting to go to record valuations, that may have been a very early signal that maybe we should just start moving a quarter basis points at a time. You might have got to the destination right now, but you could have smoothed it along the way. And the other problem is that we don't really talk about out there is it's not just the qualifying, it's not just people in their sticker shock, if you will, on renewals. And I don't know if people would agree with this point. I think there's a real opportunity here where there's erosion of wealth. And what I mean by that, I'm not talking about outside markets and things you guys are experts in. I'm talking about, I think most of us realize that a lot of people have made plans based on these equity levels in their homes. I mean, we all sit around a coffee table and I'm going to sell my home one day. I'm going to move to, Peterborough or wherever the case may be. And I'm going to take that, that whole speech. And I think it's only a theory, but I think most of your viewers know by now that a first-time home buyer, literally, at least in my world, about 80% of the time, that down payment is coming from the bank of mom and dad.
Yeah.
And guess where mom and dad are getting a lot of cash sometimes?
Their own house.
Their own house. They're using it as an ATM. So what we're doing is we're just creating this self-fulfilling prophecy in some way. So that keeps me up at night. And I'm worried about it.
So if anyone has a question, we'll definitely get to them. If you just hover over the Q&A and type it in, I see them coming in now. So thanks for that. We're just going to go over our script, and then we're going to definitely address all your questions.
Yes.
So let's talk a little bit about what's happening in the private side, because I know that that's an area that you understand well and keep your ear to the ground about. So over time, I remember you telling us you were at the housing conference and you mentioned that it could be upwards of 20% of originations. What have you seen sort of more recently, and what's been the trend, and is that a problem?
Yeah, I don't think that trend has changed in terms of there's still a larger proportion of businesses, or excuse me, that mortgages that fall into what we call these private markets. Now, just to be specific, we're not just talking about like onesie, twosie type of investor who self-directs an RSP, or I'm classifying mortgage investment corporations, those types of things that fall into that. Some people call it shadow markets, really not in my mind.
Yep.
It's really just boutique specialized lending that's generally equity based. So that proportion is still high. And I think it's not a cautionary tale, but there is a correlation to when rates start to increase like this, that private mortgages become a lot more attractive. And I'll explain why, at least in my experience, is when we're talking about a 7% mortgage to qualify.
Yep.
Right? You may not qualify.
Yeah.
And all of a sudden, if your face rate on an insured deal is like 5.5, if a private investor says to you, Anthony, you know what? I don't care about the stress test. I like the home. You've got enough equity. Here's a 1-year deal for $599. People will take that because the qualifications tend to be a little bit less. It's more equity based. The rates, there's no disparaging gap between the two. So they're, in my estimation, in simple terms, you're not going to see a decline in private business. I think you're going to see an uptick as these rates go up.
Are you worried that they're the most, that they're vulnerable though? Are they doing good deals? Are they stretching?
When you say they, you mean the
private.
investors? It's hard to say. I mean, I can tell you unequivocally, just from empirical experience from running those businesses you mentioned in my past, is most private lenders get it. They know that this is an equity-based situation. You shouldn't really lend beyond a certain loan to value. So you've got some room in there, 70, 75 on a first mortgage, maybe lower depending on your market. Have I seen situations in which, without naming any of them, of course, mortgage investment corporations who are flush with cash and can't move it fast enough and start making decisions that probably aren't the best? For instance, they may decide to go higher on a loan to value on a second mortgage. I think that's a dangerous play, particularly, well, let's just overlay the stats, right? So if you're a private investor and you're going behind a mortgage to, let's say 85% loan to value. Well, the last stats we just saw suggest that roughly valuations today have decreased about 20. We're talking about basic math here. We got a 5% problem, right? And then the other problem is for the private investor more so is if, and knock on wood, never want to see this to a Canadian family, but if that house has to be taken back for arrears or defaults, you're in second position.
Explain what happens.
So what'll happen is, simple forms here, okay, is you get to the point where if you have to take back the house because you just can't remediate, you just can't help the problem, the lender, the institution, whatever format it is, has first right on that mortgage because they're in first position. So let's use a number. Let's say the home was $100,000.
Yep.
And you originally borrowed $750 against it. Okay. And you decided somewhere down the line you wanted to get a line of credit because you want to put a pool fence and whatever else, right? And you got another 10%. So now your total mortgage out there is about $850-ish, right?
85% loan.
85% loan to value. Well, if the market dropped and continues, that $1 million or that 100,000 is actually 800,000. You're in the hole. So that sort of weighs on my mind. A little bit.
And what will happen is if the house goes into default, you in the second position have to either assume the first, right? Or basically you lose your, or hope that they can sell it for more to cover your second. Otherwise you're under.
Listen, we can chop it up any way we want. The bottom line is it's not good. It's not a good situation. And it becomes very clunky when you have those mortgages that are second position behind, especially other institutions.
And when you look at some of these private, because we've spent a lot of time looking at some of these MIPs, they're paying out 8%. And when rates were 2, 3, and even 1, and they're still paying you 8, you have to imagine that they're taking on some other higher risk lending. Otherwise, how can they do it?
Well, I mean, listen, you're in a better position to say, make this point, but the riskier any vehicle is, the higher the yield tends to be, right?
You got it.
And that's kind of what you're getting into when you're talking about those kinds of lenders.
And you and I have mused about this, but the stress test. So family A goes in to get the stress test. They got the mortgage at 2% even, let's say, because they got it early on during this pandemic, and they were tested at 5.25%. So everything's going to be fine, right? We stress tested them at 5.25%. Everything must be fine. Yeah.
Exactly. That you would think, but listen, consumers are consumers.
Exactly.
It's like, okay, well, yeah, I stress tested at 5.25%. But I didn't contour my spending habits at 5.25%. I know that my mortgage is $1,000 a month as an example. I don't think about, oh my God, my mortgage could be $2,000 next month. Even though you were stress tested at 2,000, it's not like the person put aside the extra 500 or 1,000 that they were stress tested that assumed that they could afford. They said, I have this extra disposable income magically. So you know what, let's upgrade the car. We'll go from the 3 Series to the 4 Series.
right? We'll put that pool in, etc. So age old problem. What sort of things are you watching in the lending side as gauges of, going to increase your concern here?
Obviously defaults and arrears, just wondering, I'm concerned about that. I'm concerned about what is the solution that we're going to put forward for home buyers. The interesting thing is, before all these recent discussions, all we've heard from federal policymakers is home ownership, home affordability, on and on. We've actually made it worse. And I understand, one can say, well, the current government put in this awesome program for first-time home buyers up to $40,000. Who cares? Because at the end of the day, yeah, you may have disaffected valuations. So maybe the home prices came down a bit. They didn't come down to a level where they're suddenly more affordable. And then now you've made payments arguably triple when they were 12 weeks ago. And you've made the stress test, the buying power has been reduced. So what's interesting is you've elevated the qualifying by an enormous percentage that's beyond the decline of valuations. You've got a bad intersection here. So what they're trying to accomplish is actually becoming an unintended consequence. Instead of making things affordable, we've made it actually more unaffordable. And that concerns me a lot. Because the other thing too is when you overlay other numbers, like give or take, rounded number, there's about 2 million pent up immigrants just waiting, process, just sort of waiting to come. Where are they going to go?
So that could save us, the whole immigration story.
I don't know yet.
Interesting.
I don't know yet, because what we don't know is what are the long-term impacts of qualifying at 7%.
And we have, we had a question come in, thanks for that, about foreign buying. And what are you seeing as far, because foreign purchasers has been a ban now.
Well,
so tell us about that. How's that played out?
Well, the first thing is, I'm a little bit tongue in cheek. How does the government even monitor that? Let's put in that. What mechanism or monitoring device do we have in place to ban that? Right. So I'd love the government to be asked that question, because there is no answer. So assuming they can make an absolute assessment here, because they banned it. What I think people lost in the shuffle over the years is, well, we're just going to tax these foreign investors. Well, I've had the pleasure of talking to some really good people who are foreign investors, and they couldn't care less. They actually laughed, because where they're coming from, these are honorable people, where they're coming from. There's a whole list of countries that, you just have to watch the news. There's value to them taking money out of those unstable economies and countries and protecting them in what they perceive as a stronger economy and a stable economy. So to them, when you say, I'm going to charge you an extra 3, 4, 5%, they're fine. That's not a deterrent to them.
They have a different cost of capital.
Totally different cost of capital. To them, there's huge value in capital protection rather than capital return.
So you think there's been essentially, that's just been a little bit of a
overplayed
lipstick.
Overplayed. And I have no way of making any commentary at this point about this, quote unquote ban, because it's so early, and I know there's no device to really track it. So we'll see.
Right on. All right, so let's go through some of the questions that have come in.
Sure.
So they're talking about raising rates, raising rate environment. Buyers with variables will get caught off guard. We know the total monthly payment for a fixed or variable mortgage just balanced between interest and principal. So cash equal the perspective. Is it different from for mortgage holder? I think we went through this point about the issue with variable and adjustable rate. Are you finding that this is a situation that people are aware of as the mortgage, as mortgagors taking it on that loan? Do they really understand?
I'm going to play altruistic and hope that the answer is yes. Because, if you're going through, I'll give you an example. If you're going through a mortgage broker's job is to actually disclose the risks, right?
Yep.
And the ones that I come across do a really good job of it. In fact, it's actually disclosed on a form that a consumer signs, right?
Right.
We're not all naive. We also know that the emotion of owning a new home with the kitchen you love means sometimes you'll forego the details.
Yeah.
Right. So my concern is that they subconsciously knew, but didn't pay any heed to it. There's actually a secondary issue there. And the secondary, so one of your guests there, question is very well put, because I think they're identifying that if you're in a variable rate mortgage, you're really not attacking your principal in the way you want to at this point. That's really the critical point. But the other side of it is, you might hear from mortgage professionals say, well, you know what, it's okay, because when, prime and these variable rate mortgages still are pretty good because they're discounted off prime.
Yep.
And we can convert them to a fixed rate at any given time.
Sure.
Which is basically true.
Yep.
Here's the problem. That prime is moving at the speed of light. And what are you going to convert them into? Because 100 basis points off prime, not that long ago, 3 months ago, meant what, 1.7, 1.6, 1.5, 1.8, somewhere in there in terms of an effective rate. Now you're starting to get into those 3s and 4s, even with those discounts. And if a customer gets edgy and says, Anthony, I don't want to be in this anymore, my rates or my payments are going everywhere, put me in a fixed. Oh, okay. Well, your fix is going to be 5 or higher.
And now you're in a big tougher spot.
Yeah, so it's a tough spot.
So let's talk about their CMHC program. Can make buying more affordable for buyers in the housing market. The new one that CMHC has put in place that they've talked about, has that even come out? Does it even?
Well, there's a couple programs.
Sure.
You're talking about the ECO?
Yep.
Yeah, it's, honestly, goodness, it's really too early to tell. It's such a fresh paint. No idea yet. None. It's way too early. Yeah.
Okay. Let's see here. Which one is?
By the way,
Go ahead.
sorry if I may. So that question is interesting. I'm assuming that your question asker there was asking about the program in which they'll take, quote unquote, seemingly an equity position in the home.
Yes.
Yeah. Well, I can tell you out of real life experience,
That's what we want.
yeah, most people are reticent to touch that program.
Why?
Well, so their view, it's actually, there's an argument that says, depending on what you deem as the valuation increase per year, per annum on a home,
Yeah.
versus maybe I'll just borrow that money, maybe I'll just take it from mom. I'm not giving any equity to the government.
Got it.
Right. So that's my experience. They've been really reticent about the program.
How about other cities? And I think this is, other markets. So GTA, we know, I think it's remained relatively stable, but out the further you go from the core, what about if we go, let's take it a little bit more across the country? Someone asked specifically about Montreal, but other cities.
I would say this, any of the major markets that we're all sort of used, like Greater Montreal, Greater Ottawa, Greater Toronto, Greater Vancouver, very, very similar patterns, right? With the exception, of course, the Greater Vancouver and the Greater Toronto, right? Just the mortgages and the home values are at a whole different stratosphere, okay? But they've all experienced similar patterns in terms of sharp rises and those things that we're all aware of by now. What's interesting is every time we see these types of things, first of all, we've never seen this kind of rate increase. This is ridiculous, but generally what happens is when houses in one market tend to be a little bit more out of reach, you start to see those secondary markets just go on fire. So it's no secret right now, like the Edmontons, Calgarys, Red Deers, Lethbridge in Alberta are becoming a lot more attractive. Regina and Saskatoon now are highly looked at. I think most people on this call realize that during COVID, maybe they don't, maybe I shouldn't assume that, there was a massive movement from GTA to the Atlantic provinces.
The Atlantic, yeah.
Why? Because let's go back to what we talked about, that playing with the equity. People thought, geez, I can get $1.5 million, $2 million for my home in Toronto. I can get a beautiful place by the water in wherever for $400,000 or $500,000. And those are real numbers at the time, actually. Yep. So the more affordable markets, the secondary markets tend to just all of a sudden the switch gets on.
We had Ron Butler, who you know.
Yeah.
Ron was at our housing conference last year, and he commented that the housing prices in outside of GTA, when we go to the cottage and et cetera, he used the term, they've gone batshit crazy.
Yeah, well, he was absolutely right. Absolutely. It's interesting. I'm sure Ron probably touched on this at your conference, but one of the very first signals that we should have really paid attention to is right after COVID started. Around May 24, June of 2020, cottages were going like crazy.
Yep.
And like cottages now, like a decent cottage on the water, and if you're like, Muskokas, Kawarthas, you better get ready to spend $1.5 million to $2 million. But these things were flying off the shelf like they were $10, cups of coffee.
Yeah.
And, so when I made that comment earlier, there might have been a signal to start these measures sooner.
Yeah.
That should have been the first flag.
Right. And and to our point, just to reemphasize, those are the houses you see as most vulnerable.
Yeah, I would say this in a simple term is generally when things go like this and people get shaky, the secondary and recreational properties go first. Rentals, those kinds of things, cottages.
So when you look at what do you think's more exposed to the higher rate risk? The house, the single family, or not single family, let's call it the owner occupied, or the investment market?
The latter.
The investment market.
Yeah.
And when you look at today, the lenders, and you walk in and say, look, I'm buying this as a second property, I'm buying this as my primary residence, or I'm to live in. How does the lender look at that differently, or do they?
Yeah, we have to. Yeah, it's a great question. So just, very high level. So if it's an owner occupied home, I mean, you can go up to 95% as an example, right? If you're, we talk about first time home buyers a lot of times. If you're looking to buy a non-owner occupied rental, like truly you have no intention of being in the home, it's an income generating home, you need at least 20% to have that conversation. And sometimes depending on market, it could be actually less. So there's a counter argument that says, yeah, they're more susceptible, but they also have more equity in there. But that's when I say, you asked me what keeps me up a little bit.
Yeah.
I would say, whoa, pump the brakes. Because if you're a renter, or excuse me, if you're a buyer that bought a rental unit even as early as a year ago, and assuming that this continues on as we see it, we just declare that housing values are down 20%. So your 80% loan to value right now is 100.
Boom. And your rent doesn't cover the cost to carry. It was the case already, and now it's worse.
That's a whole different conversation too.
And so now they're under real pressure.
Well, let's say this, good luck, and I'm being tongue in cheek here, but good luck in these markets that we're talking about, especially GTA, GVA, finding a rental property that you can actually make the math work. So most of these rentals, in my experience, in those larger markets, are kind of just breaking even because the whole thought process, well, I'll just have someone else pay for my equity, blah blah blah, which usually means you're cash flow negative, right? So then these investors are going to say, is there going to be a mass exit? Are they going to put the houses up for sale? No, because most investors, what I think is going to happen is going to say, well, you know what, this might be a blip. I still have 3, 4, 2 years. I'm going to let it ride out, and I'm hoping for them, and I'm going to knock on wood that the market does improve, because if it stays the way it is now, they have some real decisions to make.
Now, maybe someone's asking us to be a little bit more clear about private lending versus mix, and because the mix, they're public. There's a number of them that are public. There's private mix. There's also private lending generally. That's just many of the people that we know that just lend their own personal money and or money of investors. Maybe you could provide a little bit more
I'd love to.
color.
Generally, in my side of the ledger, when we talk about private mortgages, truest form,
yes,
it's really just somebody who's got some money,
Bank of
Scilipoti. A lot of times it might be a self-directed RSP as an example, right? Yeah. It's more of a one-on-one relationship.
Yeah.
There's not a sophisticated institution behind it. It's just a guy or gal or someone who's trying to do something with their savings. So that's what I would define as pure private. Then there's the private mortgage investment corp. So the mix, as you described, they're not that. So what that is, simple terms, is a bunch of people decide that they're going to put money into an entity. So ABC MIC, and the private lender doesn't necessarily have any decision making on where those proceeds go. Right. Whereas if it's you and you're lending, you're to look at it, you say, I like the house. So you have full control of your decision making.
Yes.
Private MIC, even a public MIC for that matter, you put your money in here, we're going to strive to give you a return of
there's a portfolio manager.
There's there's got to be a PM there.
PM, yep.
And
he's licensed with the OSC
a lot more
if he's raised the money.
Yeah, and don't get me wrong, there's some really excellent professional, they know what they're doing, mortgage investment corporations. I would say that between the private space and those really good mortgage investment corporations lies these little private mortgage corporations who thought, oh, wow, this is easy. I can just lend money. There's no risk. About 3-4 years ago, I'm just gonna get a bunch of friends. We're gonna do the good old mortgage investment corp. And those are the ones, Anthony, that I'm talking about that have made, I've seen it, have made some decisions that make you kind of sort of scratch your head.
If you do the math, emotion aside, where should real estate prices be a year from now?
Oh, man.
Thanks, Scott. That's the
Scott, if I knew that, I wouldn't be here. Well, last year I had
but listen, I had it written down. I was going to ask you later, but
okay, I'm give you my
pressure here.
And this sucker's recorded, so we can go back and see how wrong I was. But similar to the question you asked me in April 2020, where do I think rates, or 2021, you asked where do I think rates will be, and I said I think they're going to increase. I'd be a complete liar if I said I thought they were going to increase at this rate.
Right, that's what we.
I think I actually said probably about 100 basis points. I think is what I said. So to answer Scott's question, if I had to pick a year in which we could use as a model for where I think the valuations will be next year, I would say late 2018, early 2019. And the reason why I say that is I think those are more normalized years, because right around COVID, with that March of 2020, is when things just got stupid. We had 20% increase, and then we had 30% over the 20% in 2021, and houses went nuts. So I think we're going to go back to closer values that we saw in 2018, 2019.
Albie, that means that's like
I know 30,
that 40%.
Well, Scott asked the question, so I'm just giving you the answer.
Yeah.
This is my, I don't, Scott, I don't know.
And write this down. I've been saying this, that we just went through what's called what will be called the COVID bubble.
Yeah.
We had the .com bubble. That was a COVID bubble.
Yeah.
And it affected because the cost of money was so low, and not just the cost of money, but money was coming for free to companies, individuals. Then spending became free flowing. The ability to buy, the cost of buying anything just came down. And so we'll see where this goes. Let's talk a couple. I'd keep the questions coming, so I'm doing my best here. Is there a portal tool to see the number of year-to-date mortgage applications loaded in the country, such what we see in the U.S.?
No, that's such a great question. This actually kind of barks back to that mechanism.
Like you see this in your net, what you're seeing, like
the
mortgage, and you guys only do insurable, or you'll do any kind?
Yeah, we do uninsurable, insured, and high ratio. Yeah.
Okay, so keep going. Sorry.
Yeah, I mean, it goes back to the whole comment about, it's one thing to say you're going to ban foreign investment, but what's the tracking mechanism?
Right.
There isn't a central repository for information to feed. There's discussions about it, but I mean, there's been discussions on that forever. So no, the answer is no, there's no central point.
Okay. This is a good question. So for variable mortgages, and you commented how basically the payment stays the same, right? But what changes is the amortization period. Now,
no, what changes specifically is the amount that gets paid to principal and interest. Yeah,
perfect. Now, there must be a trigger. There must be an uncle at which point the interest rate is so high such that there's no more principal to absorb, if you will, in the payment. What happens there? And is that the case? Is there a trigger rate?
Is there a trigger rate? That's a great question. Now, so what'll happen is really, it's a very simple process. So let's use us as a lender. We don't sell variable rates specifically for the reason you just discussed.
You only do adjustable.
We won't touch variables.
Do you do adjustable?
We do adjustables because as things go, good or bad.
Yeah, but
the variable program,
squeeze.
It becomes a conversation. It becomes a very clear conversation between consumer and institution, because that could happen.
So it's a conversation. I thought it was written in. It's not written in?
Well, it's hard for me to comment on that because everybody has independent, every lender has different policies and how they tackle that. Some may go as far as to say, once you get to a certain percentage of the payment that's interest bearing, things happen, right? So it's very institutional dependent.
I'm going to ask a question which is tied to this. And I love asking you this question. Is there any lender that you see out there? Because you see deals, right? And they come across your desk and you wouldn't be the first place they go, right? They're gonna come across the Royal Bank and the A lenders, let's call them, and then later they'll come to you.
No, because we're a company that is a pure A lender. So we are still a destination of first choice, for lack of a better phrase, for lenders.
Perfect.
We're not the mob.
You're not that, right.
Okay.
So who's the, when you see deals and
Yes.
you go, this came in, it's like, oh my God, how did this get on my desk?
Yeah.
And you see that coming in and you have obviously your risk group, right? And then it gets done by someone else. Which
I see your
organizations
question.
are those ones?
Yeah, well, you know what, okay. Here's how the pendulum goes,
Let's do it.
generally. So every client wants the best mortgage rate they can possibly get.
Yep.
Without really understanding their own credit situation, right? So generally what will happen is it will start with what you might call, quote unquote, an A lender, which means you're getting the best rate possible.
Yep.
Right? Once a consumer falls off that because for whatever reason, maybe not enough down payment, which is usually not just that problem, but usually it's credit ratings and things like that. Then they'll go to the next tier, right? And there's some really reputable organizations that do a great job with this kind of business. So maybe this person's got a little bit more equity, but their credit is so maybe you look towards two institutions I think the world of, even though they're sort of kind of competitors, Home Capital Group and Equitable Bank, right? That's their thing. So you go to what you may define as A, AAA, down to B or B minus, B plus, which might be those Home Capital Groups, because they do a really good job.
But they're taking up the ones that aren't covered by.
But that's not, listen, I can't speak for Home Capital Group. They're a sharp group, but after that, if any of those types of secondary lenders say, like, this is not for us, you start to touch on those private mortgage markets that we talked about.
But what about within the primes? Because if you turn it down, it may well be that one of the banks absorbs it. Is there a lending institution that you've started to see that they're taking on some more deals that you would say, okay, you know what, these are a little bit.
I see the question. I'll try to put it in simple terms. If it's a mortgage that requires higher ratio insurance, right. It used to be as easy as it was really one insurer many years ago. So if that insurer said no,
CMHC,
so then everybody knows there's no matter. Now you've got a few more insurers. Is it possible that maybe they go to lender A and lender A says no, and then maybe lender B says, maybe?
Yeah.
Not a lot. That doesn't happen a ton. Back after your question, are there institutions out there that would take a loan that most lenders would say no to? The answer is yes. I can speak to the proportion. I won't mention who they are, but
you will or won't?
Will not.
Okay.
Because you guys are all smart enough here to figure it out on your own for sure. But
actually, we're not. We don't know.
Okay, I'll just say that we're a mortgage finance company, right? So we're a monoline lender, as you said. We have no interest in deposits. We have no investment vehicles.
Correct.
We only do one thing, and we try and do as best we can, right? That's it. So to us, if someone has an investment account, or they've got RSPs over there, or they've got some savings here, or they got a checking book there, it doesn't mean anything to me.
Correct.
It may mean something to someone else. So that someone else may say, I'm not sure I would do this loan, but I have a strong balance sheet. I can insulate it because all this other stuff around their wallet's really important to me.
Right.
Understand?
Mm-hmm.
So I don't have the stats. I mean, no one really does. How does one know if a particular institution is taking on more loans than they should? We don't know.
Yeah.
But it happens.
But it's interesting that you said one, it's more the multi-dimensional business line organizations, because they look at you holistically, whereas you can't. You just look at it and say, here's the loan, here's the borrower. What do I see?
Correct.
All right. So how competitive is the mortgage market in Canada? Can a buyer get a meaningful difference by shopping around the different banks?
Wow, that's a great question. I don't think I've ever been asked that. I would say that not so much. I mean, to be frank with you, maybe many years ago, but the problem is now the consumer's way more educated than ever was even 10 years ago.
Mm-hmm.
So now, generally speaking, most institutions put their best foot forward. Maybe not so much on a new mortgage. There's still a little bit of room sometimes. On renewals, you're kind of doing okay. Listen, I'm putting on my old hat. I think the best answer to this is if you want to make sure you're getting a great job done, don't pretend you're a pro. Like I don't know anything about cars. I'm not fixing my car. I'm going to a mortgage broker.
Right.
Let them do the work, because they'll do a heck of a better job than the average consumer.
How fast do you think these cottages erode? It took them 6 months to go bananas. How fast do you think they erode?
Very slow. And I'll tell you why. It may sound like a suck and blow because a lot of these cottages were bought in the last 2 years. Okay. So let's presume that most of these people, if not all of them, got 5-year mortgages. They're only 2 years in. Okay. So if they're on a fixed rate that was funded 2 years ago, their payments are still really good. And they're just going to hope, like most Canadians, maybe I can weather the storm. Maybe in the next 3 years when I have to renew, things look different. So I don't think there's going to be a mass exodus of people selling their cottages yet. So how about this for a more salient point? I think those that jumped on the bandwagon when COVID started, locked in these recreational properties at a really good rate.
Mhm.
They still have time on their side.
Right.
To hang in the game. Part two will be my answer will be, I think what will deter is there will be a softening on buying those properties. When I say softening, I'm not saying that it's going to be eroded to the point where no one's buying them, but I don't think the $2 million cottage is going to be $2 million cottage anymore. Might be 1.25, might be 1.4. I think it'll come back to a little bit more normalization.
And I think, and maybe you correct me if I'm wrong, but what we watch here,
Mhm.
I think what could lead to more pressure on prices is what happens to unemployment. Because
Oh,
right
yeah.
now we're getting hit with rates for sure, and that means your buying power is down today anywhere between 8 and 10% just by the move that's taken place, if not more. But for now, jobs are there. Now we're starting to see some companies start to make small cuts here and there, but if that exacerbates and people actually start losing and we start to see more job losses, that's where I think we're going to really see the pressure.
I think that is an extremely fair point. I think something that gets lost in the shuffle, right, is this isn't the 60s. And what I mean by that is those were single family dependent incomes, right? Which is different quality of life, different cost of living. Now, yeah, everyone can say, yeah, well, but most households have 2 incomes. Yeah, not by design or not by choice, right?
Yes.
It's out of necessity. And it may be that you have one income earner who doesn't lose their job, but if the other one goes, what the hell does that look like?
Yeah.
You know, it's a real challenge.
It's
And remember, we don't qualify, you know, a mortgage company or a bank or we don't sit there and say, listen, Anthony, we like everything we see here, but you know what, we're not going to advance the law because in 3 years from now, you might lose your job. We don't do that.
Mhm.
We underwrite with what you have here. Yeah. Now, if there's some uncertainties, we mitigate that through stuff, but so I don't know if I answered the question, but that's my view.
No, that's good. And this ties in with it that someone's asking another question. Have the lenders already started to get more stringent? Have you guys gotten more
Yeah,
stringent?
I understand the spirit of the question. I don't know if we get more stringent per se, because most lenders already have a pretty robust, what we call an RMUP, which is residential mortgage underwriting policy. So just a book of how the roadmap of how we look at loans, how we qualify loans. What we're doing now, and I'll talk about the outside companies too, what we're all doing is just asking sharper questions, right? Making sure that we have some, what we call mitigation. What we are seeing a little bit more of is companies are not taking valuations at face value. So maybe more specific.
Yeah. So I had that written down.
Is it?
Yeah,
Okay,
keep
yeah,
going.
so I think it's an important point is, so not so long ago, if you had a high ratio or insured deal, you would absolutely obviously deal with the insurers who've got incredible valuation models.
Yep.
Because they have all this data, right?
Sure.
And they wouldn't normally typically say, hey, Mr. or Mrs. Borrower, you got to go to an appraisal because they're happy with their valuation. So we're starting to see more of, not sure we want to just rely on this data set. Let's get some street.
And when are you starting to see, well, let me turn it around. I've started to hear that transaction A took place at $1.2 million.
Mm-hmm.
The lender's saying, yeah, I know you bought it at $1.2 million. Well done, Collu family, but we're going to send out our appraiser because that deal
Correct.
you did was 3 months ago when you signed the paper and you're closing now.
Oh,
And we're going to do an appraisal, and all of a sudden it comes in at 1.1. So now you're in for
Very
another
true.
80K that you got to pay, or another 20K that you got to pay, 80K, 100K that you got to cover. Where are you going to get it?
that is exactly, you know, it's funny you bring this up. It's really relevant here. I did a presentation for a mortgage group, I think 2 weeks ago or so, somewhere in there. And I just asked, you know, what's your biggest pain right now?
Yeah.
And there it was like chaos when I asked the question. The biggest problem they were having is people were buying. There's a twofold problem.
Oh, here you go. Yeah.
The first problem was exactly what you identified. The house was listed for $1 million, but everyone wanted to overbid and they paid 1.3. Appraiser comes in and says, this thing's maybe $1 million. We as lenders, doesn't matter what type of, we don't care what you paid. We care on what we're actually securing our debt against. So what does that mean? That means if you went into a home expecting to have X amount of down payment, you have that 300,000 above that million, that's your problem.
Yeah.
Right? So if you bought $1 million home and we said, you said, I need 20% down as an example. So you need 200 grand. You really need 500 now.
Yeah.
So what's happening is that, so brokers are, some of the brokers I dealt with are dealing with this. And part two is people went nuts during the high time, bought a home before listing. I know you and I talked about this.
Oh, yeah.
And this is not anecdotal whatsoever, is we have issues where we're starting to see deals fall apart. Deposits are lost. And that just creates a whole series of dominoes, right? Bought the house. Now I've got mine listed and I either haven't sold or I sold it for less than I needed to make the other deal work. Hope that made sense.
That's some scary stuff. Because as I've said before, and this is the thing about the housing market, and we're all very familiar with the stock market. The stock market is very liquid. There are transactions taking place each fraction of a second. In the housing market, not so much. And if this market has only 10 houses in it, if one sells for $100,000 more, they're all worth $100,000 more. The inverse also happens. One sells for $100,000 less, they're all worth $100,000 less.
Well, yeah, I mean, my cockroach theory, right? Especially in hot markets, as soon as one person sells their house quick and everyone looks at the valuation, all of a sudden 10 people are selling on the street thinking, oh my God.
And it's interesting what happened is we had a lack of supply. The number of houses listed for sale declined dramatically to record lows. Now that started to come up. Months of inventory is coming up, and that's what makes us very concerned about the current market.
Yeah,
because we're up each month this year. We've been up. Is that what are you seeing there? Is that playing into some of your thinking as well?
No, I mean, it's the same observation. We went from that red hot market to actually seeing things that we haven't seen. We went from red hot, way over ask on pricing, to now we're seeing homes days on market expiring and relists and those types of things. So that cooling or normalization, however you want to characterize it, is actually it's happening.
Here's a good question. Do you accept stock market equity value as collateral for the house, for the housing mortgage, and you do not?
No, we look at it as pure income. We don't look at, hey, someone's got $500,000 worth of BCE. We don't care. That just goes on their assets to say, okay, this is what they potentially have as an asset base.
Yeah. We
only look at income generated.
But do other lenders, specifically banks, do they do that?
Not that I'm aware of. I mean, we'll look at, all of us will.
No, not you. I meant the banks.
Yeah, no, we're not that far off. I mean, we're all sort of kind of in the same way,
I've heard they do.
What we'll do.
No, not you, but I meant that the banks do.
I'm trying to be very delicate here. Remember, I mentioned a scenario in which sometimes some places will do a loan that probably isn't really the type of loan you want to do, but they happen to have all these other things.
Yes.
That might have been one of those things.
Got it.
Okay. But in a pure standpoint, no. We'll look at someone who has consistently gained interest income, like on a T5 as an example.
Yes.
We'll definitely take that into account.
That was very smooth. You're good.
Yeah, I try to do what I can.
It's not your first rodeo here. All right, a few more questions. I don't want to take up too much more of your time, but thanks all for your patience. I'm trying my best here to get through all these questions. Okay, here's a good one. Is there a general percentage breakdown of variable versus fixed lending in the marketplace?
Oh, great question.
Is there an average term of months or years on the fixed lending, and how much pain in short term versus mid to long term?
You know what? It's hard. I don't have that data right here. There are stats that I could provide, but I can tell you just out of our business,
sure,
which is, we're sort of a sample size of all the business anyway. We have seen from the moment rates started to increase.
Yes.
Not even at this rate, like just they started to move the business. We started to see larger and larger proportions of adjustable rate mortgage applications.
Oh,
yeah. So,
as soon as they started going up.
So yeah, that's what normally happens when you start to see fixed rates go and prime's kind of still attractive.
Oh, I see.
So we started to see a lot more ARMs, adjustable rate mortgages. I would say in the last, since all this stuff that we talked about is taking, I would probably say that 2 out of 3 mortgages we're getting right now are basically adjustable rate mortgages.
2 out of 3.
2 out of 3, whereas a year
I'm so-
ago, we were lucky if they were 1 out of 5. Maybe that is even too high. So dramatic shift in a short period to those types of mortgages. But as far as aggregate data, I mean, if you need that, Anthony, for that particular question
Yeah.
ask, I'm happy to get them for you.
Sure. Why don't you
Yeah.
pass that on, and we'll include that. How about including foreign income in the
Not
application?
often. Very, very rare.
Okay. And so let's see if we can wrap this up. And if anyone has a question, keep sending them in here. I think we've gone through all the questions. But so let's try to pull this together. You're starting to see some transactions break down. You're starting to see some stress in the outskirts.
Mhm.
You're starting to see some pressure from lenders, not pressure, some more stringentness, if I can use that word, from some of the lenders, because they're keeping an eye on what's going on and asking more questions.
Yeah.
They're sending out the appraisal after, even though the transaction took place, and all this is taking place. And so we're in the early stages.
Mhm.
What would have to happen for you to say, hey, you know what, Ant, this is not a big deal? And because your first instance was you thought the prices were going to get hurt from here. But what would make you say, you know what, Anthony, I think we're going to be fine?
Well, it's kind of ironic because even though I've shared all these concerns,
Yeah.
I'm not on the cliff.
Right.
Because really, what the heck are we talking about? If we simplify this conversation,
Sure.
we're not talking about over 20, 25-year pendulum. We're talking about since March 2020. I do think, in a positive line of sight, I do think we have time on our side for those that engaged in buying a home or a cottage in the last
Right.
2 years.
Mhm.
That's the first checkbox, right? So
Because the rates are low.
I'm not suggesting that they're not nervous about what they're seeing, but they have no reason to be nervous. If you got a mortgage 2 years ago and you're at 2%, you don't care if the mortgage is 6, 7% now.
Correct.
Or 5. I don't care.
In fact, if you sell your house, you can sell the mortgage with that house, and that actually is a selling feature.
Well, okay, we'll park that for a second. We'll
Okay,
come back.
okay.
But so I'm not saying people are going to jump off the cliff. So that's number one. Number two, I think what you're really impacting more so today than anything else,
Yeah.
is really the simple point that you are discouraging new home ownership. You are eroding equities in existing homes.
Yeah.
And you being the federal policymakers have put a real opportunity for people who had mortgages 3 to 5 years ago to get some incredible sticker shock.
Yeah.
Right. So again, those that bought these properties within the last 2 years, I think they're going to be okay. No one's going to go nuts. Because even if they did try and sell and said, well, geez, I paid $2 million, I can only get 1.6. I'm riding the wave. I'm fine. I'll wait another 3 years.
Mhm.
Right. If I had to pick one thing that bothers me is I just don't want to see Canadian families who thought, geez, over the last 5 years, I paid down my mortgage by $125,000. And then they get their new mortgage rate. And it's like, oh my God. Not only did it not go down, I'm paying more than I did originally.
Yeah.
That bothers me.
All right. Is there, what would you advise a buyer today? Fixed, variable?
Well, listen, it's hard for me to say that because every borrower's got their own situation. Here's what I would say is if you are thinking about a variable and adjustable, you bloody well better make sure you understand the risks, right? It's not like with a fixed rate, I know this is what my payment is going to be over X amount of term. Let's call it a 5-year term. And I know that's what I can count on. And I know that when my journey's done, even if I don't make prepayments, I'm going to pay off at least this much of my mortgage. You do not get that insurance on a variable.
Right.
You do on an adjustable because you're still steady. So just be very careful. And remember, if you do want to go on variable or adjustable, you eventually have to lock in.
I'm just going to launch our poll here.
Oh.
So that everybody can tell us what a great job you've done, Albert.
Hopefully I didn't bore anyone. It's hard to take a lot of this data.
All right. So your favorite book, aside from the one you've written, I should have mentioned he's actually an author as well.
Thanks.
Catapulting Change. It's a
Thank
fantastic book
Thanks.
about management and dealing with change management. I didn't mention to you, hopefully you figured that out as I was explaining your bio. He's been through a lot of management change, a lot of management adjustments, and some difficult decisions I know that we've had to talk about that you've had to make with people, with structures, your own decisions. So kudos to you. And,
Thank you,
it's a cool book. So you still have to sign my copy. Eh?
I will.
You're
My
killing
favorite
me.
book, though, is actually Good to Great.
Nice. Jim Collins.
Absolutely.
I gave that to all my employees. I think that's a great book. Agreed. And favorite podcast?
This one right here.
The Fact Finders. I love it. That's beautiful. All right, Albert, we're gonna keep an eye. We got our housing conference. We've just started to make public some of the presenters. We'll see how we can get you involved as well. But October 6th this year. And thanks everyone for listening. We're going to keep a careful eye on this. It's changing rapidly.
Yes. Thank you.
Thanks everyone.